Yo, what's going on, guys? Welcome back to day 4 of the mentorship. Today we're going to be going over order blocks, what they are, how to spot them, why they matter, and just how to avoid bad order blocks, how to find the right ones, stuff along those lines. So before we get into this video, if you haven't already, make sure to go ahead and like and subscribe to my channel. There's a lot more coming, especially with the mentorship. Obviously, there's going to be 31 days of this, so if you guys haven't watched the previous videos, day 1, 2, and 3, day 1 I went over the mindset that you need in order to become a profitable trader. That's probably one of the most important videos that I would recommend going over first. Day 2 we went over market structure, and then day 3 we went over fair value gaps. So go ahead and check that out. I do actually have another video on fair value gaps on my channel. I just decided to make day 2 or day 3 a little bit more in depth on fair value gaps and just kind of give you guys a better understanding of all of it. So let's go ahead and get into it. So again, here we have our notes that we're going to go off of here, just to kind of give me a base, just so I'm not just going off my head. But what are order blocks? Okay, so order blocks are areas on the chart where institutional traders like banks or hedge funds execute large orders. So think of them as zones where the big money or the smart money gets involved, creating significant price reactions. Okay, so these levels that you're going to see are not necessarily just patterns. They are patterns, but they have to be logically and narratively backed with the drawn liquidity that you're looking for. Because there are so many order blocks that appear on the chart that look like an order block, but most of them are not going to hold. Most of them will get ran through. But since we're going to go over order blocks, we're also going to go over breakers as well in this video, just so you guys can get a good understanding, because all a breaker is just a failed order block. So yeah, think of them as zones where big money gets involved and creates significant price reactions. Now, why do they matter? Okay, institutions can't place all these massive orders in one position all at once. So what they have to do, they got to scale in and out so that they can actually have their full positions, and they stop certain people out to refill their orders so that they can get in at a good price, I guess. Because if institutions and these big banks with all this money just get in at one certain area, their fill is going to be way, 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 way different from where they got in at the initial price. So they have to actually fill more and more and more orders and stop tons of people out before they can continue on their move to whatever the drawn liquidity is. So how can you identify these order blocks? Well, you need to look for an engulfing type candle that takes liquidity or taps into some sort of PD array. So an order block often ends with an engulfing candle that shows a strong shift in momentum, right? So a bullish order block is a strong upward move following consolidation. So it doesn't always necessarily need to be consolidation. So if you are identifying a bullish order block, you're going to be looking for a sharp move down in the opposing direction of the liquidity or the drawn liquidity, followed by a sharp move up, trading above that opening price of that bearish move down, right? And I'm going to give you some visual examples as well. So if we look in the chart here, right, I'm just going to use a rectangle just to show you an example. So for a bullish example, I'll show you both too. For a bullish example, you're going to have a bearish candle like this, okay? And again, please don't just look at this as patterns. You have to use them with logic and a backed narrative towards that specific drawn liquidity, okay? So imagine this is a bearish candle, right? This is a bullish scenario. So you're going to have a bearish candle followed by a bullish candle, okay? So this one's supposed to be black, right? At least for my chart colors, and this one's green, right? Before this green move happens, right? Either from this candle or from the green candle, from the black or the green, there's going to be either a sweep of liquidity or this leg tapping into a key PD array. If that happens, then that means it is most likely a valid order block. If we take the path here, you're going to have a move like this. So a lot of the times, price will create the order block out of a key level down here, and then price will come and usually tap the wick or whatever the body of it and start to reverse. A lot of the times it won't tap the bodies. Sometimes it will. It just depends on the type of structure that you're looking at. But most of the time it will tap the general area of that order block if it is valid, and then we'll continue on the uptrend, right? So that is basically the bullish order block And same thing goes for bearish, right? You're going to have a sharp move up, tapping into a key PD array or taking out some sort of liquidity, followed by a move down, right? And then same concept applies here, okay? All you're looking for is a move back up to that order block to fill those orders, and then retest, and then continue to go towards whatever the drawn liquidity may be, okay? So we'll go ahead and look at some chart examples now, just so you don't see, lines and rectangles on the chart, because I want to give you guys a good understanding and just keep this as simple as I possibly can. So in regards to an order block, right, as we know, price is fractal, okay? So there's going to be order blocks on the 5-second time frame, the 1 minute, the 15-minute, the hour, the weekly. It's going to be on every single time frame. It's about identifying the right ones and aligning it with price, or aligning it with time, right? Aligning time and price is very crucial, very important. So if we go back to the trade, or the day that we took a trade on Friday, the last day of the week, you can see a lot of, up and down moves. You're like, okay, how can I even identify an order block here? Okay. Like I said, if you're looking for a bearish order block, you need to wait for a move up, tapping into some sort of key level or taking liquidity, followed by what? A move down, just like I showed you in the visual example up above. So where can we find one? Let's go and look in the chart here. So again, there's going to be, it could be a 2-candle sequence like I just showed up there, or it could be multiple, okay? Let's say you have, on the 5-minute time frame, you have that one move up followed by a move down, for a bearish example, right? If you go to the 1-minute time frame, it's going to look like a lot of other candles, and green, black, green, black, green, black. It's just going to be kind of like a consolidative pattern, but if you scale up, it's going to be a lot more clear and concise. So you can almost be more precise with marking these order blocks, instead of just having a big chunk of price there in front of you and not really knowing what to do with it. So if we look right, let's see, where's a good example? Okay, right here. So notice this, right? We have this move up, tapping into this key level, this fair value gap right here. Let me remove this rectangle so you can see it a bit better. So we have this fair value gap right here, right? Right here. Notice this candle sweeps liquidity, right? Tapping a fair value gap is a sweep of liquidity, because on the lower time frame, this candle wick right here is a swing high, right? So we sweep liquidity into a key level. Now, if we mark this here from the body to the body, that is your order block. Now, the reason this got traded through is because obviously price had higher draws for the day. So most of the time, if this was a valid order block, price would come up into it, and most of the time the wicks would respect the midpoint or mean threshold of this order block, right? Now, in this case, I might remember I told you guys I would explain breakers. Now, in this scenario, since this is a bearish order block, it did get ran through with some hesitation, but a bearish order block that gets ran through is a bullish breaker. So you have a bearish order block, it trades through it, and then basically creates that bullish breaker. So most of the time it will trade above it, retest it, and then that will show support in price, which will lead price higher or to wherever the drawn liquidity may be. Okay, that isn't the best example. I just kind of wanted to show you like the pattern sense of it. Let's look for another example that actually makes sense here. Okay, so this right here. So notice how we have this sequence of candle moves down, right? We have a sequence of candle moves down followed by a move up. This is what I meant by kind of having that consolidated price area, and going up a higher time frame can make it more precise. So obviously we're on the 5-minute. If we go to the 15-minute, what can we notice? Well, it's a bit more clear now. We could even go on the 30-minute to see. Boom, look at that. The 30-minute. Look, we have a move down followed by a move up, right? This right here, right? You can mark the wick too. It really doesn't matter. Like most of the time, if you mark the body, the wick from the body, it isn't going to be too much of a difference in terms of points. In this case, right? If we go from the body to that wick, it's 14 points. And although that is quite a big difference, if you're in a lot of size, 14 points can, make a big difference, especially if you're in 5 minis. If you're in 5 minis, right, 1 mini is equivalent to, or Yeah, one mini is equivalent to $20 per point. So if you're in 5 minis, that means what? 20 times 5, right? So that's basically $100 per point. So if it moves 14 points, that's $1,400, right? So it kind of depends on how you're trading, the way that you trade. If you're a scalper or a day trader, it just all depends on your risk. So if you look here, right, the reason this is a valid order block here is because on the lower time frame, we did end up having an SMT here. All this here, these wicks reacting off of midnight open, is all this support that we're having, right? And this move down followed by this move up is a valid order block because of all this here. This is technically your key level, right? You can even look on a 15-minute time frame and see, okay, did we take out any liquidity? Technically, yes, we did. If you look back on the 5-minute, you can see here that we have this low, this low, this low, right? These lows were taken, right? This is an intermediate term low or protected low, right? Which means if we are bullish, we do not want to see this low get taken at all. So this whole sequence move here is an order block. You just have to go up a couple time frames to make it more clear, right? And you can notice, right, we create this order block, react off all our key levels, and retest it off this wick here, which sends price all the way back up towards our draw on liquidity right here, right? Same concept applies. Look at this. We have a bearish order block here, right? You can mark this and this. That's your bearish order block, right? Why? Because, look, we swept out liquidity, and we also swept out liquidity here. So this is a valid order block. And you'll notice, too, we actually come up straight towards this body. I mean, if you zoom in a little bit, it's a little bit off. It's like a tick off, but still it's the same kind of idea. If you mark the wick too, it's there as well, right? So this is a bearish order block, and right here is a bullish order block. You could even look over here as well. This looks like a bullish order block too. This would not be a bullish order block. Why? Because we never swept out any sell side liquidity. You could go on a 5-minute and see, is there anything here? No, it's just a whole bunch. It's just accumulating on the 5-minute time frame. There's no valid order blocks here anywhere, right? I mean, if you really wanted to get into it and look and see, there is one, but this just isn't necessarily clean price action in my opinion. So that's kind of the idea, what I'm trying to get at. So we got our bullish order block here, and we got our bearish order block here. So it's just levels where price wants to fill, right? Stop people out who are short before making the actual move down, right? And that's an issue that a lot of people have. They get the draw on liquidity right, but they end up getting stopped out before the move actually happens, and then they get pissed, right? That's normal. It happens to a lot of us, right? No one's perfect when it comes to trading. We all make mistakes and we all lose, okay? So again, a recap on breakers. A bullish breaker is a bearish order block that gets ran through with displacement with a higher draw on liquidity. A bearish order block is a bullish order block, a bearish breaker block is a bullish order block that gets ran through and trades back up into, and then continues to whatever the draw on liquidity is, okay? So the structure or the pattern for what a breaker would look like would be something like this. And please don't just go off of a pattern of a low, high, lower, low, higher, high. It needs to be an order block that is ran through for it to be a valid breaker block, okay? So all that looks like, it's very simple. It's a low, a high, a lower low, and a higher high, okay? This is a bullish order block. So the order block in this case would be here. This would be your bearish order block. And what you'd expect is for price to come back into it, respect it, and then continue to trade higher. Same concept applies for a bearish breaker block. That'll have a high, low, higher high, and then a lower low. In this case, right, a bullish order block right here, which gets ran through, and then of course, what happens? Price comes back up into it, respects it, and then continues to trade lower. Now, there are a lot of scenarios in the chart where price won't actually come up and tap that. Now, why is that the case? And same goes for a bullish scenario. The reason for that is because sometimes there will be PD arrays or some other points of resistance that will make price not need to come up into here because basically all the orders were basically filled in the order book. I don't get into order books or anything like that. I just trade pure price action, but if you want to get super technical about it, that's basically what it is. So it could be anything like a fair value gap. It could be midnight open, right? Imagine this new week opening gap right here is midnight open. It can test this, and price won't need to come up here because, you know, there's a lot of resistance in this area, and there's just no need for it to come up there. It does come with a little bit of experience, you know, seeing it over and over again and kind of coming up with your own basis on why it's happening. But for the most part, I don't just trade off breakers. I use them as confluence. I use them as areas of support or resistance where I could frame my idea and then trade off of that. Like, you know, it could tap the breaker and then it leaves an IFVG here, and then I short right here and then catch the full move back down, right? So that's the whole idea of what a breaker is, okay? So if we go to let's see if I can find some examples here for you. Oh, here's one right here. I'm blind. Okay, so look, we have a low, right? Swing low, high, lower low, higher high. It's the same thing here. Low, high, lower low, higher high. Trades back into it and then trades towards the drawn liquidity. It's the same shit here, right? We get the low, the high, the lower low with the SMT, higher high. What happens? Price comes back into that order block and then trades higher. Yes, you have to be patient, you have to wait, but if you just want to trade breakers, go ahead. It works. Breakers have like a 70-75% win rate if you just trade strictly off breakers, right? Imagine this, if you put your limit here, that's a beautiful fill. You get filled and then immediately price trades up 50 points from your entry, right? And then you have a clear drawn liquidity, which was previous day high from Friday. So that's all a bullish breaker is the A right here, B, C, and D. But like I said, you don't want to just look at it from an A, B, C, D pattern. So you have to actually identify the bullish order block here, which will get traded into later. So this is where it's super concise and super precise right here. So instead of marking the full-on leg down and then the whole move up, you just be a bit more precise and mark the leg that gets broken through right at the last second. So this would be your bullish order block here. And look at how precise it is. It almost fills the entire box and then rejects off of it. So that's what you're looking for a bullish order block. Bearish order block is the same exact scenario. You wait for a high, a low, a higher high, and a lower low. Let me see if I could find an example for y'all real quick. This is not the best, honestly. There's not some good examples in here. Okay, here's one. Look, we have a high, a low, higher high, lower low. How can we be more precise with this? Just go up a time frame. So what we can do here is look at the entire move up versus the move down, right? So this is the whole move up before the move down. That's your order block. And look at how perfectly it respects mean threshold of it, right? You can even go up a slightly bigger time frame, and boom, look, there's just one candle followed by two now, but you can go to a 15 and see if there's any difference. Wow, look at that. Move up, move down, perfect. So it's all about identifying the right order block, and the reason this is good is because it taps into a key level, right? So this is what happens. We trade back lower, tap the order block or the breaker, and then we come straight back down, right? It looks like a bearish order block from this point of view on the 15-minute, but on the 5-minute, right, it does look like a breaker because we do have our high, low, higher high, lower low. So you always have to be going through different time frames and sorting out what makes the most sense and what's the most logical. Don't overcomplicate it. All you got to look for, sweep of liquidity followed by a sharp move in the opposite direction, right? Bullish breaker, like I said, again, recapping that, bullish breaker, all a bullish breaker is a bearish order block that gets ran through, retested, and then trades in the opposite direction, okay? Bearish breaker is a bullish order block that gets ran through, trades in the opposite direction. It's that simple, okay? And I basically just gave you the rundown of what they are, right? Bearish order block gets ran through. So in this scenario, right, we have a bullish order block, gets ran through, taps it, which creates the bearish breaker, which then goes towards the drawn liquidity, okay? Yeah, that's basically all order blocks are and breakers are, right? I didn't really want to make another video just on breakers because I knew I could implement it into this, but yeah, that's the whole, I guess the chart way of viewing it, okay? So like I said, we had that engulfing candle, right? Like I said, meaning we have that, right, on the 15-minute. The candle gets engulfed, that bullish candle gets engulfed by the bearish candle, creating this bearish order block, right? Like I said, this is a bearish breaker, but this is also a bearish order block. It's just kind of one of those scenarios where it kind of happened, right? Because if you look on the 5-minute, right, this is a bullish order block. So here, let me show you. This is the bearish order block, which gets tapped up into. But if you look here as well, let me remove this. This right here, this whole sequence, this move down followed by this move up, this right here, this is your bearish, your bullish order block. And you'll notice it gets broken through, right? Retests this gap, trades lower, and then retests it. So in a sense, this is a 5-minute bearish order block and a bullish order block as well, which gets traded through, creating a bearish breaker, okay? So that's really all I'm looking for. And one more thing I want to go over too, wicks on a higher time frame, or really any time frame that you're looking at, because price is fractal, right, is an order block. So what do I mean by that? Let's go to an hourly time frame and look, okay? So what's a good example here? Let's see. You know, I'll just mark one and just kind of show you what I mean, okay? So if you look at this wick here, right? This wick, let me just replay this so it doesn't make it difficult for me. So this wick right here, if you mark the whole wick from the body, the close of that candle, and to the end of the wick, right? If we go down to a 5-minute time frame, what do we notice? Move down followed by a move up. It's a bullish order block. Look what happens. We trade right back into it on this move down, almost like literally to the tick, almost, but you know, it's basically there, right? We had this volume imbalance holding us up, which is why we didn't make it all the way back down to this specific price level right here at 673, right? So the same concept applies for a bearish scenario. Is you mark a wick, because if you think about a wick, right, all a wick is the price went up and then went straight back down, creating that wick for a scenario at the top. Same concept applies here, right? 15-minute time frame, or sorry, hourly time frame. Right here, price opens on this hourly bearish candle. So we open, this whole candle here at one point was black. So we had a move down on the lower time frame, and then a move back up on the lower time frame. So if you're viewing this, right, you're going to have one candle that's doing all this movement, right, up, down, up, down, up, down, but on a lower time frame, it's going to be something like this. You're going to have the initial open right here, right? It's going to open, and then it's going to print the move down, followed by the move up again, right? That's all this candle is. So if you look at a candle in the hourly time frame, it's going to look like this, right? So we open. We're going off of this candle right here. So we open, price prints all those lows, right? It'll do something like that, create the structure, boom. It'll put in the low, and then it'll, boom, come up, leave the wick, and close there. That's all it is. So it's all depends on how you're looking at it from whichever time frame, right? So that's really all it is. Like I said, I'm trying to keep it as simple as possible. If you guys have any questions, please let me know down below. But yeah, that's basically what it is, okay? So I also did put in market structure breaks here, just because I know a lot of people are like, oh, market structure shift, break a structure, whatever. It's kind of like a beginner concept, but it's when price breaks structure after forming an order block, it confirms institutional interest in that zone. So that's exactly what I meant by showing you those examples. It'll displace through a certain level after tapping liquidity, right, creating that order block. So that's really it. Order blocks are not super complicated. Again, I'll mark it out one more time for you guys. This is a bullish order block, black candle, followed by a bullish candle. Again, these two candles down here have to tap a key level or sweep some sort of liquidity for it to be valid, okay? Again, bearish order block, right? We have our green candle here, followed by a black candle right here. Boom. This is your bearish order block, bullish order block. Again, breaker, right? Let me go back. This is a bullish order block. Price breaks through it, creating a bearish breaker, trades lower, okay? Again, here, we have a bullish order block. What can we expect here? Or sorry, bearish order block. What can we expect? Price trades through that bearish order block, creating a bullish breaker, tapping the order block, creating the bullish breaker, and then continues to trade higher. That's it. That's literally it, okay? So yeah, let's go back to our page here. Volume spikes, I put that in there just so, it happens sometimes. You'll get a sharp move in volume, which can kind of give you an idea that institutions are kind of taking their part and making their plays there. So, oh yeah, it often signals institutional activity. So, you don't need to know this. I just wanted to put this in here just to have some sort of education. But why do order blocks even work in the first place, okay? So there's institutional intent, right? Institutions don't randomly pick levels. They use these order blocks to manage their risk and enter high probability trades, right? These guys are different than us. They don't have, $1 million in funding, bro. They have hundreds of millions, if not billions of dollars that they trade with. How on God's green earth are you supposed to enter tens of millions, if not hundreds of millions, in one little area? Let's say you enter at 2,600 for longs. You're gonna get filled down here, bruh, because you have so much capital and so many different orders that need to be filled. These institutions need to know when to actually get into those positions to actually make those huge moves. You'll notice a lot on the chart. You'll have, weird moves. You have a move up, move down, move up, and then out of nowhere, you'll just see a huge efficient move out of nowhere. That's where the institutions come into play, and that's where you need to actually catch those trades. You need to follow along with those banks and be able to do what they do, okay? And sometimes you're not going to always catch that big, efficient move. There's other moves that work, right? So it's just about being picky and knowing what you're looking for, okay? So we went over entry points, right? Either the wick or the body of it. If you want to get, a higher chance of winning every single time, well, you're never going to win every single time. But I guess what I'm trying to say is if you want to have a good chance of getting tapped in a lot of the time, just go with the wick, bro. The wick is probably the best thing that you could go for, right? They provide these precise levels for entries at their price returns to test them, okay? Wait for those confirmations, all right? Wait for that tap. If you want to even get more precise, wait for that tap, go to a lower time frame and take an inversion. That's what I do. Works for me. I have a pretty high win rate, as you guys can see. But again, stop loss placement too. Where would you put your stop if you took a trade off an order block? You literally just put it below the wick of the order block. That's it. If you're shorting, just put it above the wick of the order block. That's it. Because you would expect that level where we actually tap into that liquidity, we sweep that liquidity or tap to that key level, you'd expect that high to be protected because order flow is bearish in this scenario and we want to see lower prices. So you just put your stop above it, right? Take profit targets. It could literally just be any other point of liquidity, another order block, right? A fair value gap. It could be anything, right? Any point on the chart is a level. Any point is. It doesn't matter because there's always going to be another person to buy what you've sold or sold what you've bought. So a lot of people misidentify order blocks, and that's what I said. If price doesn't tap into a key level or sweep any sort of liquidity, most likely it's not a valid order block. And we're going to go over mitigations in another video. Mitigation is basically just the opposite of a breaker. Like I said, we'll go over it, but y'all need to understand when to take a trade off an order block and when to not take a trade off an order block because it's not a valid order block, okay? Again, there's going to be a lot of recaps in the future where I go over a lot of my trades and you guys can learn from that as well. If you guys want to learn with me, you got to work with me one-on-one. I do have a link down below. You can go and schedule a call with me and we can see if you're the right fit for the program that we are running currently. And yeah, so another common mistake that people make is ignoring the higher time frames. And like I said, the wicks on the higher time frame pose as order blocks, right? You just have to go on a higher time frame, mark it, go down to a lower time frame and see it actually play out, right? So ignoring higher time frames, that's a mistake that I always make. So always cross-check with higher time frames to ensure alignment with institutional order flow, okay? And again, don't overcomplicate it. Keep it simple. Focus on clean and clear zones. If it's not clear and it's just a whole bunch of chop, don't think you need to execute or take a trade. Just get off. Come back and wait till price is clean, okay? Price most of the time is always going to be clean on a higher time frame regardless. So yeah, that's basically what we're looking at here. So I gave you those examples: bullish order block in an uptrend, a bearish order block in a downtrend, entries, stops, and targets based on those blocks, okay? That's really all I got for you guys today. It's really not complicated at all. Again, if you guys have any questions, anything, put it down in the comments below. I will even make another video if there's something that you guys are confused about. Whatever the case is, I'm here for you guys. I want you guys to learn. I want you guys to be successful. So with that said, please leave a like on the video, subscribe if you haven't already, and I will catch you boys in the next video on day 5. Peace.